U.S. payroll employment fell. The prior 2 months were revised lower. Yet the S&P 500 and Nasdaq 100 finished the week near record territory. That is not a reason to celebrate weak employment. It is a macro contradiction that exposes two different stories inside the same market. The labor report weakened the growth picture. The equity tape still reflected confidence in output and profits. Which side is the market actually pricing? Begin with the official report. The Bureau of Labor Statistics said non-farm payroll employment declined by 23,000 in July. The unemployment rate was little changed at 4.1%. The revisions were more important than one monthly number. May was revised down by 66,000 and June by 37,000. Together, the prior 2 months contained 103,000 fewer jobs than previously reported. Wage growth did not accelerate. Average hourly earnings rose only 2 cents in July and were up 3.2% from a year earlier. This is evidence of slower labor demand. It is not, by itself, proof that the whole economy is contracting. Now place the market response beside it. Over 5 completed sessions, the Nasdaq 100 gained about 5.1% and the S&P 500 gained about 3.6%. Most of that advance came before Friday's jobs report, so the report did not cause the weekly rally. The narrower observation is still notable. On Friday, the Nasdaq 100 rose about 0.4% from open to close, and the S&P 500 rose about 0.3%. The 10-year Treasury yield traded as low as roughly 4.60%, then closed near 4.66. The dollar index fell about 0.4% on Friday. Weak jobs created rate relief pressure, but the long yield did not finish the session dramatically lower. Stocks held their ground anyway. The missing mechanism is productivity. One day before the jobs report, BLS estimated that non-farm business productivity rose at a 1.4% annualized rate in the second quarter. Output rose 1.7% while hours worked rose only 0.3%. Unit labor costs rose 1.3% annualized in the quarter and 1.4% over the year. Those figures do not erase employment risk. They show how businesses can produce more output without matching it with the same growth in labor hours. That distinction matters for equities. Slower hiring can signal weaker demand. But higher output per hour can support margins and earnings. The same labor softness can therefore be read as a growth warning and as evidence of corporate efficiency. There are 3 limits to the optimistic interpretation. First, productivity is an economy-wide average. It does not guarantee that every company will protect margins. Second, a weak payroll report can become a demand problem if consumption and output also deteriorate. Efficiency cannot offset falling revenue forever. Third, rate relief is conditional. The Federal Reserve had already said inflation remained elevated. If inflation stays firm, weaker jobs do not automatically produce lower long-term yields. The next validation is unusually clear. July consumer price data are scheduled for August 12. If inflation cools while payroll growth remains weak, the rate relief mechanism gains support. If inflation remains elevated, the market faces the less comfortable combination of softer employment and limited room for lower rates. Also watch breadth. A broad equity advance would show that resilience is spreading beyond the largest technology companies. A narrow advance would leave the headline indexes dependent on a small group of earnings engines. Finally, compare the 10-year yield with the 4.60 area tested on Friday. Sustained yield relief would confirm that bonds accepted the weaker labor message. A return toward the week's highs would show that inflation risk still dominates the long end. Jobs down and stocks up is not proof that bad news is good news. It is evidence that markets price the path from labor, to rates, to productivity, to profits. The labor side weakened. The productivity side remained positive. Equities preserved their advance while the bond response stayed incomplete. The experiment is to watch which link breaks first: inflation relief, productivity support, or equity breadth. Subscribe for future weekend lab experiments. Daily observations are posted at Market Validation Lab on X. The link is in the description.